Everyone dreams about living an uncommon life, but how we define that dream is very different for each of us. And for most, it's a lifelong pursuit. Welcome to the Uncommon Life Project podcast. We're going to introduce you to people who are living that life or enjoying the journey to get there. We're going to also give you some tools, tricks, and tips for starting or accelerating your own efforts to live an uncommon life, a life worth celebrating and savoring. Please welcome your hosts, Brian Dewhurst and Phillip Ramsey.
Hello and welcome. This is Phillip Ramsey.
And this is Brian Dewhurst.
With another episode of the Uncommon Life Project. Man, I get jazzed up when I hear that intro music, don't you?
I do like it a lot.
Yeah, come on. Anyway, today we're talking about the first, source of residual income and our 7 sources of residual income, and that's banking. And you might be thinking to yourself, wait a second, like I don't get any residual income or cash flow from my bank. And you'd be exactly right. Banks don't really do that, or do they right now, Brian?
They don't, unless you tie your money up in a CD. You might be able to get 1% to 2%.
And you know, my favorite part about the actual interest they do send you from the banks is you get taxed or you get 1099 at the end of the year, which is exciting when it's only 32 cents. Because they're only paying 0.001% on your checking account. But that has not always been the case.
Not always. And I remember, back in 1999, I opened my first brokerage account and my money market earned 5.5%. I mean, I couldn't even imagine today what that last 18 years would have been like if you could have just earned 5.5% consistently on your money, year in, year out. And I think when we use the word banking, most people don't understand banking. They know how to walk into a bank and do what the bank tells them to do. But banking at the core is just the movement of money through your economic engine, or whatever you want to call it, through your life. So banking is just the movement of money. And historically, the movement of money through banking has earned you interest. And so this could also be maybe the vein of like saving versus investing, right? If you're going to access the money prior to 5 years, then that's savings type money. And if you're going to hold it for longer than 5 years, that's typically investment type money. Other way to look at it is like, I don't want to lose any money. That's banking or savings money. I'm willing to take some risk. That's investment type money. Trying to keep things super simple. But we want to talk about banking because we have a different way to bank.
And to be honest with you guys, this is the reason why Brian and I are sitting where we're at today. And it really started with, I got into the business about 5.5 years ago, and I was just completely frustrated. They told me to go get a list of 200 of my family and friends to go talk to. Mm-hmm. They told me they were going to get some great training process for me, which was basically, I'm going to break this down, so hang on. It was call your 200 family and friends, closest family and friends. Ask them how much they're saving a month. Think about that. Ask them what would happen if one of them never showed up after work. Just kill one of them off. Make the other one cry because that was important. And then take some of that money that they were saving every month and sell them more life insurance. There it was, everyone. Just did it.
It's an amazing training program.
So I was just frustrated, right? Like that doesn't resonate with me at all. It doesn't for any of my family and friends. And so I remember calling my family and friends, and they would be so gracious, letting me sit down with them. And the first thing I would say is, I have not figured this out yet. And what they're telling me, there's no way I'm going to talk to you about it. And so Brian and I had coffee. And I remember just being, I think probably at first we were both like, everything's great. Yeah. But both of us were like hating our life. And I was just like, man, there has got to be a better way, because I just cannot sell the way they want me to sell, how they want me to sell. It just doesn't seem different or uncommon, which at that time I was not uncommon wealth partners. We're here now. But, and so Brian was like, there is a different way. I just don't know how to sell it. And so for the next, I'd probably say 2.5 hours, Brian laid this concept out to me. It dovetailed so well because his dad was in insurance, his uncle was in banking, and his mother was in securities and investments. And so all of this knowledge, Brian just got to just completely be around his whole life. I never was around it. And so he started thinking about ways and different ways to help people with his money. That was what he talked about that day at that Faithful coffee shop. And that's the reason why we're here today. And that's kind of the reason why it's number one on Residual.
Yeah, so true. I remember that coffee so well. And once we got past the quintessential everything's okay, God got to work. And I think, yeah, you don't appreciate, I think, everything in your childhood until you get older and you start looking back. But yeah, I just remember at dinner, we would just talk about work or hear my parents talk about work. And I was an only child, so there was really wasn't a lot of other people to talk other than me and my parents. And, that's all we talked about a lot was just money and investments. And then when I got into consulting with Deloitte and Touche, and I spent 5 years auditing some of the most storied companies in America and seeing the power of business and cash flow and those types of things and just multiple streams of income, I was able to start to put together that background in banking, that background in insurance, and that background in investments into a strategy that we feel is more rewarding, more predictable, and less risky over time, and truly more, I would say, diversified than just putting all your money in the stock market and praying to God it doesn't go down. But I think we saw that in 08, 09. Everything went down in concert with each other, with the exception of our uncommon banking system, and that's what we want to get into today. And so, banking is essential to understand. Most people don't understand it, and so with that said, banking is comprised of multiple strategies or sources. We all need a checking account. We all have a debit card. Most people have a credit card now. If you play the point game, if you don't, that's up to you. But we think banking has 4 key components, and we're going to get into this first. On our list is the uncommon banking system, which we'll dovetail into, and which is going to be the highlight of this episode. And then 2 is gold and silver. Gold and silver have acted as currency for over 5,000 years, over 400 mentions in the Bible. Every known civilization documented in the history of the world has had an adornment, use, fascination with gold and silver on every corner of the planet. And now we have cryptocurrency, which we're seeing a lot of interest and intrigue in. And then obviously 4th, and the reason it's last is because it's the one that's obviously the most simple and the least profitable, is just leaving cash at the bank, checking account, and your basic transactional type solution for banking. But we think banking is comprised of all 4 components, but you should probably leave the least amount in the bank and potentially, fund these other multiple strategies. And we'll kind of get into that more. But today we're going to focus on our uncommon banking strategy.
And so what is that exactly?
It is, I wish we had like an automated drum roll. It's cash value life insurance. And I love what the look people give us when we first say it, because it's just like, oh my gosh, get me out of here. But the environment that it creates is what we're after, not necessarily the product. And I think, you always say to people, and it's so, I think it's so true. It's like, if we could get our money in this environment and it was to buy cattle, then we'd buy cattle. It's about the environment the policy creates for our money that we're trying to achieve. And then using that as an instrument, as a banking tool, is the secondary, mechanism. And so that's kind of what we want to get into today is cash value whole life insurance. And I think, as you look at life insurance in general, you have term life, variable universal life, index universal life, and whole life for the most part. We really typically only sell term and whole life because, term is obviously needed in some instances to cover assets and different things. But predominantly, we do believe in cash value life insurance as a source of residual income, as a way to build and protect wealth, and as a way to bank. Compliance caveat, an insurance company is not a bank. This is a banking strategy. Banking is just the movement of money. So this isn't a bank. We don't want it to be a bank because they have 2 different jurisdictions, tax structures, all those different things.
Yeah. So, my uncle, and he's not my uncle, but Dave Ramsey would absolutely have a cow at this point, right? Like, what are you talking about? And so I think it's important to say kind of the way and the history of how this kind of evolved. And the person that started this concept kind of fell upon it was a man named R. Nelson Nash. And Brian and I have had the, I'd say, privilege of meeting him in person. and hearing how he talks about money, the Federal Reserve. He has all these different things that he just starts going on and on about. He's 87 when we saw him.
In his 80s, I think.
Yeah.
Somewhere in there.
But anyway, so the guy just gets fired up, and he talked for 6 hours. I don't know if he took a break. At some point, people were like, "Can we just take a break? We got to go to the bathroom." But the guy is on fire, and the way that he found this strategy was kind of a fluke.
Yeah, it's interesting as we interview business owners. I don't want to call it dumb luck because I think that's minimizing it a little bit, but just that, like, you're at that point of there's a fork in the road and you need the right fork, and God met him there. So yeah, he had basically the same story as Dave Ramsey. He was on his knees, praying to God for a way out of being over leveraged in the 70s and 80s, on real estate with variable rate interest loans, and interest rates went to 21%. And he was looking down at all of his financial statements on the floor, and he saw, loan value on his whole life insurance policy. And he called his agent the next day and said, "Hey, can I take a loan on these policies? So there's a loan available." And the guy said, "Yeah." And he goes, "What's the interest rate?" And the guy goes, 5%. And he's like, "Oh my God." It was one of those moments, and he realized he could take a loan against his life insurance and pay down or pay off, restructure the interest or the loans on his real estate. And he was able to keep the properties and, basically not go into bankruptcy, which oddly enough was the path that Dave Ramsey went down. He did go into bankruptcy because he didn't have that backup asset class. I would say Dave Ramsey's a better marketer than R. Nelson Nash has been in the strategy, but, we're here now talking about it. And so really, Nelson Nash released that book in 2000 or 2001. So this strategy or concept as a philosophy in order to organize your money and cash flow is very infant compared to, the big insurance world which you came up in, or the investment world that I kind of grew up in with my mom's firm, of just putting all your money in stocks and bonds. And so it's kind of a concert of the three of banks, insurance companies, and investments, and how do those three work together so our clients actually succeed.
For sure. And so R. Nelson Nash started this whole concept, but there is another, I guess, famous person that I want you to talk about that used this strategy for a crazy reward. And who was that?
Yeah, that's Walt Disney.
Uh-huh.
And probably one of my, I don't know, I call it like a divine moment. I was fortunate enough to go on a trip to Disney World in Florida for, expense paid trip. And there's a little movie theater there that has like a 10-minute video on Walt Disney. And I'm sitting there by myself, kind of at a point in my career of like, do I keep going down this path? We're kind of paving a new trail. People are telling us we're crazy. And in the video, they talk about Walt Disney, how he was in California with his two daughters, and he was taking them on daddy-daughter dates, and he was just bored. He didn't know what to do with them. And that was actually the genesis for the idea of the theme park, Disneyland in California. So he went to the bank, said, "Hey, I want to borrow this money and do this theme park with my cartoons and stuff." And they're like, "No, you're crazy." And so the actual seed money for Disneyland was a loan against the cash value whole life insurance policy. And they say that in the video, the documentary on Walt Disney at Disney World in Florida. And it was just one of those moments where it's like, God couldn't be any clearer. And so, the question that we always ask our clients is, it's like, what was the return on his life insurance policy? We get so hung up on the interest rate or the dividend and all these different things, but it's like, it doesn't matter what the return on his life insurance policy was. What mattered was that he brought a dream to life and he shared it with the rest of the world, right?
Yeah, I wouldn't say it doesn't matter, but it's in that comparison, it doesn't matter for Walt Disney. He didn't care at all, but we definitely do talk about that. And so we mentioned the book of R. Nelson Nash, and that book is Becoming Your Own Banker. And our clients don't even know who R. Nelson Nash is, honestly, because it's something that when you read that book, at least for me and probably you as well, you can read it and you understand it a little bit, but to actually put it in your own
to implement it,
it's a whole different deal. And so, but I would say that the way that he talks about it in there is there's a couple main points. You want to be using a mutually owned life insurance company, and you don't want to be using these universal life, variable universal life, and the reason is because they're one for the people who own the policies instead of stockholders. And an example of this that I've kind of in my training, I got trained with Principal Financial Group. That's just who they were, and they demutualized in 2001. And when I started getting trained there, it was I think
10 years later,
2011. Yeah. So they started telling me, oh, well, you got to use variable universal life. Uh, you got to use universal life.
Yeah.
And then they would always tell me to quote interest rates that I felt were a little off, right? Like 12%, like really? And oh yeah, that's right. And I started doing more and more research because I would get calls about people who had a mutually owned whole life insurance policy. And so I asked them about that, and they're like, oh no, we don't sell that anymore. We're a stock owned shareholder company. We're really for the shareholders. But I'm supposed to be selling this to my 200 closest family and friends. Like, it just didn't seem like it resonated. And so that's when Brian and I started talking, and I started understanding more about why it's important to have a mutually funded company that will pay you dividends because you own part of the company, right? Because you just bought a product from them. And so that's the reason why R. Nelson Nash says use a mutually owned company. And so I would say there's a lot of people also that have been trained under R. Nelson Nash that put way too much emphasis on a policy. They try to put too much money into it.
It's oversold.
It's oversold. And guys, we are not telling you this is a get rich quick scheme. This is a system over time that can be powerful for each one of our clients, if they think it's for them. But how that works is it's important for us to show them their actual numbers in the system so they can conceptualize it in their head. So what exactly is this concept of uncommon banking?
Yeah, it's just where we teach people how to, we call it overfunding. Essentially, the insurance industry over-designed whole life insurance policy, and they created what's called a paid-up additions rider. It's kind of like just think of it like a extra savings account you can bolt onto your policy, and it just allows you to dump in excess cash. And we've always been trained by the insurance companies how to sell insurance, which is to sell the most amount of death benefit for the least amount of premium. What we do is actually the exact opposite, because that's what helps them win, right? The insurance company. And the agent makes the most money that way. The client gets they think they have the best deal because they're paying the least amount of price for the most coverage. But really what they've done is they've committed the fateful error by putting the least amount in. You don't capitalize your business. And so like a typical whole life policy won't break even until like year 13 to 17, depending on the carrier. And typically in the first 3 years, you don't have any cash value. We kind of do it the exact opposite, where we're trying to buy the least amount of death benefit for the most amount we can put in relative to someone's personal plan. So this isn't like crazy or free money or anything. But when we do that, we actually drive down the cost of insurance, and we hit a break-even point from a banking standpoint, meaning like we've put X amount of dollars in a premium and the cash value is worth X amount of dollars. And that's accessible via a policy level. And that's the power to the whole thing. And what the rich have figured out is how to get multiple uses on their money. One of the major ways, rich people get richer is real estate. We see that with Donald Trump in the White House. Real estate's powerful because you can put in a down payment and you can leverage the bank and you can get other people to pay you rent. And that rent is inflation protected. You get a tax protection for owning real estate through the IRS tax code. And it's a great way to build wealth. Well, a life insurance policy is structured kind of the same way, except rent is a dividend. They're not contractually bound to pay it. But most of the carriers left are paying a 4% contractual guarantee in cash, and they pay a dividend above that. So the companies we're using are north of 6% right now, and you still have access to the money in there, and we show people and teach people how to borrow it out and leverage it to pay off debt or buy assets that produce cash flow. And all the while, the insurance company still owes you the interest and dividend on your money like it was still there.
For sure. So talk about the environment that you create when you open up a policy.
So the four main attributes of money that we talk about are liquidity, which is the most important, especially if you own a business. Two is safety. You want the money to be there. You want it to be, non-volatile. You want it to be safe and secure, insured, guaranteed, all those different things. Then from there is third is taxation. Pretty much everything is taxed now, minus, wait a minute, whole life insurance and a Roth IRA and municipal bonds, which nobody wants to buy. So because interest rates are so low. And then from there, you have rate of return, which we're told the stock market is 12%. It sounds great when it's up. It never seems that way when it's down. But yeah, these mutually owned whole life insurance companies, they've been paying historically 4 to 6% for over 100, 150 years. And so it's a great place to store liquid cash because the money is liquid to you. It's actually contractually guaranteed by the insurance company. It grows tax deferred, and you can access that growth through policy loans without paying tax. And oh, by the way, if you could get 4 to 6% on liquid cash, the banks can't touch that right now. And that's, when you look at, the 40s, the 50s, 60s, 70s, 80s, 90s, we were getting historical, interest rate at the bank was 5 to 6%. We saw that go up to, the teens in the early 80s, and then come back down to 5 and 6% in the 90s. And, now we're near zero again and have been for almost a decade. So, it's extremely powerful environment to store money.
So let's just talk about this because I don't want to lose any listener. So let's say you have $10,000, right? It's a lot of money. You put it into a policy, and what we're saying is it's still on deposit, even if you access via a loan that money. So let's talk through that scenario, so our listeners can kind of conceptually walk through this so they understand.
Yeah, I think this is the hardest part for people to understand because it's so foreign. We try to break it down like this. Let's say you have 10 grand in a checking account and you need a car, and you take out a loan for the whole 10 grand of the car. You owe the bank interest on your car payment, but they still owe you interest on your checking account. The money is still on deposit. It's kind of the same thing. We're putting your money on deposit inside an insurance policy, and that insurance company owes you interest on your deposit. They then pool all their money in a general fund, just actually like the banks do. Banks pool all their money and then they lend it out. And the insurance companies do the same thing. And so the insurance company says, oh, by the way, you have first right of refusal to take a loan on your money. If you don't take it, we're going to take it. And then we're going to loan it out to other people, other institutions. And these big insurance companies facilitate, massive deals, and they fund corporate projects. And they move their money around just like banks do, albeit in a less non-leveraged way and far be it safer way than banks. But that's a kind of separate discussion. Yeah, and so your money is technically still on deposit. You just have access to loan against it. So you're loaning against it, not from it. But you can only loan what you put in or what's, shows up in cash value. And so your money, this is the key to the whole deal. If you take one thing away from this, I think it's this point. Your money is always on deposit for the rest of your life. And so the more money you put in, the more money that's always on deposit, and the more money that's contractually earning interest for the rest of your life. And that's the environment that's contractually bound within a whole life insurance policy. It's a contractual obligation.
For sure. So, I think that's a huge point that people have trouble wrapping their heads around. But when we put this money into a policy, our number one objective is what are we doing with that cash value in that policy? What do we have access to? And what can we shore up for our clients, depending on what they have? If they want to go buy a rental property, if they want to pay off debt, right? We will structure that policy in a way for them. And so we have clients that are putting a lot more than $10,000 in a policy. And then we also have clients that are putting a lot less than $10,000 in a policy. it depends on how big you need your bank for. And the people who have a lot more money usually need their bank to do a lot more things than a person that doesn't have that much money. It doesn't need that much to do on the side, but it's still, the benefit is there. And so what that would look like is if you put a $10,000 in, let's say you had a loan for a car of $7,000, and you were paying $200, or let's say $300. So you put money in a life insurance policy, you take out that $7,000, and you would pay off that car. Now, because you're an honest person, you would still want to be paying back that $300, but now you just send it back to your life insurance policy that you own, right? And when you do that, two things happen. One, the amount that you owe goes down, $300, right? But the amount that you can take out goes up $300. Mm-hmm. So you're kind of doing two things there. You're saving money and you're paying off a debt, all while all that money is still on deposit, earning that higher interest rate for the policies that we use. And so that whole, I guess, it's a whole different mind shift. Now you got to think like a banker instead of a consumer, which is hard for people to understand. And eventually they'll get it and they'll understand it. And then the next year you have a premium payment due, because it's kind of a play to pay kind of thing. But we want more premium to pay because we want our bank to get bigger, and we have bigger things that we need to do. And so that's the way that we can help our clients understand the power of putting something that's always on deposit for the rest of your life. And then it goes to the point of like, oh, I wish I was just younger to do this, because it puts time and interest on your side as a client. And so how does this fit in the overall plan? That's what it's different for everybody. But we have seen that this has been a powerful concept that is something that is really easy to access. You can get your money right away. You don't ever have to go through background checks or all the different rigmarole that the banks let you do. You just, hey, I want my money. And they send you the check.
Just send you the check.
And then you go pay off that debt. Now, let's talk a little bit about, let's say you did that example. You just paid off your car of $7,000 and you graduate. At least that's what Brian and I call it. You die. What happens to that death benefit? Because there is a death benefit that Brian and I really don't talk about a lot, but there is a death benefit attached to this, and it would go down dollar for dollar. So you bought that car for $7,000. You have a loan in your policy for $7,000. Your death benefit would be whatever the death benefit was minus $7,000. So you would never have to repay that loan. It's already done. So that's kind of what happens. Like, I guess, I don't know, worst case scenario. But now let's talk about something else. Like, let's say you took out a $7,000 loan and you paid off that car, and you don't have that $300 the next 2 months. What happens?
You just don't make the payment.
Yeah. And what would happen if you did that with a conventional bank?
You got people knocking at your door.
It's awkward. And so, yeah, you have to be honest, but we feel like it's a little safer environment because you paid cash for it. The only person that you're hurting is yourself to not pay it back. You just didn't save that money that month, which in the grand scheme of things, yeah, it pushes your timeline if you're going to repayment back maybe 2 or 3 months. But now there is an interest attached to taking out a loan. And right now for the companies that we're using, it's 5%. And so I think the argument, and we'll go into objections that people have had in the past with this concept, it's why would I ever take a 5% loan somewhere if I can just go to the bank and just pay 2 or 3%, right? And we'll talk about that in the objections. But I mean, that definitely is a question that we get a lot. And so I guess what other things that we can help people understand this uncommon banking approach that we haven't talked about? And then let's go into the objections that we've heard.
Yeah.
And then let's talk through those.
I think the big one for me, and this is kind of one I like to use, is the tortoise and the hare. We all know that the tortoise wins. And I think the hare is obviously the stock market. And a lot of people are getting exposure to the stock market through their company retirement plans. Money's going in there every 2 weeks. That's the best way to invest because you got money just perpetually going in. You got your employer putting money in. The data suggests that the employer match barely covers your taxes, pulling money out in retirement. So don't know. I think that's one of the biggest. I know it sounds like free money, and it somewhat is, but it's not all that it's cracked up to be. We obviously administer retirement plans, so I'm not saying don't do that, but I'm just saying do it as part of a plan. But I think for me, the biggest thing is so many people want to do a Roth IRA and they love the tax treatment of a Roth IRA, but then they realize how little money they can put in there and then how little they can buy with it. And it's like, well, that's going to take forever to do. So what we try to really show people is this is a Roth IRA. Cash value life insurance has the same tax structure as a Roth IRA without all the limitations. And the limitations being the funding limit of like $600 or $6,500 a year you can put in. And then two, you can't touch that until you're 59 and a half unless it's for a qualified distribution. You have to leave it in there for 5 years to get your principal back out. And I mean, there's just all these goofy restrictions.
And limit of investments.
Oh, totally. And with life insurance, there's no limitation on how much you can put in. Obviously, there's a limitation with how much you can put in just from a cash perspective and overall, like just due diligence. Like, this isn't free money. This takes time for you to get net ahead in this deal. And we show our clients that. So a Roth IRA, has those limitations and, from funding and then getting it back out. Well, life insurance doesn't have any of those limitations. And we can take a loan, for typically up to 90% of cash value. They leave 10% in there to protect the policy. And then you're getting a dividend at the end of the year. So we use the policy like a Roth IRA and as the tortoise. And then we let the hare be the stock market money with your retirement plan, and you can run the two in tandem. And the problem with a Roth IRA and doing that in tandem with like a company 401k is you're making it all later money. Like, because the 59 and a half rule of getting that money out applies to both instruments. Well, we don't have that limitation on the life insurance. And you don't want that limitation on that type of money. You want that limitation on the 401k money because you're deferring tax. But you don't want that limitation of use on your money when you're paying tax, like in a Roth IRA. And then if you go through a period like, 2000 to 2009, where you experience like 250% reductions in your principal balance, that's a horrible investment for a Roth IRA. Because not only did you pay tax, but now you just lost half your money. And so when you're paying tax on your money now, you A, want the use of it, and B, you want to know that it's going to be worth something. Well, that's what cash value life insurance is. So it's really the best of both worlds in banking and a Roth without all the government red tape. And not to mention, you can access the growth of your money tax deferred by taking policy loans.
And we've said this a couple of times, but this is definitely something that you have to do with overarching plan. How does this all fit in? Does this fit in for your situation? But what we like to do is we like to overfund a policy for 4 years. And for that example that we keep talking about, we put $10,000 in for 4 years. And people, you have no idea, like, there's no way we can do this. I'm telling you, it's closer than you think because we're not leaving that money in, right? We're taking it out and doing stuff. And then after the 4th year, it'll drop down. That premium will drop down to maybe $3,000 every year going forward.
But and they're used to saving 10.
And they're used to saving 10. And not only that, is when you put in the 3, the whole contract might be growing more than 3, right? That's ideally what Brian and I want to do. And depending on underwriting for our clients, that's what we try to achieve. But by the end of the 4th year, you've done the heavy lifting. And now you get to reap the benefits. Now you keep paying the premium. That's what Brian and I will always talk about. I think that's what differentiates ourselves from other people is we want to keep funding this thing because it's just going to keep getting bigger and bigger. The way we do that, though, is creative in helping you with your cash flow. But all your cash flow should be going back to a banking system. We advocate that it should be the uncommon banking system, not the regular banking system. Because right now, that's what everyone understands and knows. Is they go back, all your money passes through your ordinary banking system.
Yeah, I want to talk about one more thing, and we'll get into objections because I think this is important. So the other case for cash value life insurance is the investment case, or the hare case almost, tortoise and hare, is these companies that we're doing business with and aligning our clients with, they've paid such strong dividends for decades, paying dividends of north of 6, 7, 8%. Consistently for 30 years. And when you look at the adage of taking your age, from 100 and that's the amount you should have in stocks, or bonds, that is kind of what we feel is broken a little bit because, if you're, let's just say you're 50 and you have 50% of your money in bonds and rates are going up and bond prices are going down, or you've seen little to no return on 50% of your portfolio the last few years, we're coming out of a bond bull market as we saw interest rates go from 21% in 1981, down to basically zero. That increases the price of bonds. And so now we're on the flip side of that of going to zero, from zero back to probably 21%, over time. That's a horrible thing for bond prices. And so to get yield and to get rate of return and to have money that's safe, well, this is actually a very investment worthy vehicle. And oh, by the way, you could borrow or leverage against your cash value, and the insurance company is still going to pay you interest. And you buy a rental property, and now you're getting rent on that same cash. Well, now you have two sources of income off the same capital. And so it's just really powerful what we can do with this instrument from an investment standpoint, similar to the Walt Disney example. That it's just so prolific.
For sure. So let's go into objections that we have heard over the last 5 years, because there has been some. And honestly, we want to answer all of them. We've never had one that we can't answer.
Yeah. I got to give a shout out to Dave Ramsey because he has given us some of our best clients.
He really has.
Because they have great persistence, great discipline.
I'm glad you brought
And they've gotten over this whole universal hang up of this isn't for you. And now they love this strategy because their money is tangible to them again.
For sure. And I'm glad you brought this up. They are so good at budgeting.
Mm-hmm.
The people that can budget love the system. And the reason why I think they flail out a little bit, or I don't know if that's the right word, but they kind of
lose their mojo with Dave.
There you go. So the reason why they lose their mojo with Dave is because they get to the point where they're debt free, and now they're supposed to send all their money into their 401k or mutual funds. They're supposed to give them 12%. It doesn't seem like it's helping them build wealth as fast as they once were or gain traction. And so the reason why we have such great Dave Ramsey, my uncle, clients, is because we get that excitement back to them, where we can start gaining and building wealth with their policy. And now they have a debt that they know how to go eliminate. And that they start putting all their cash flow, like they used to do with Dave Ramsey, back to their policy loan. But on the outside of that, we're building a residual income, or we're building an asset that's producing cash flow that's helping them pay back that loan.
Mm-hmm.
And so the excitement level that our Dave Ramsey clients get is like, it's back and it'll never go away, because we're constantly going after what they're passionate about. Okay. Obviously we geek out about this stuff. Okay. So let's go to objections.
So we'll just fire them. So how quickly can you take a loan from your policy?
Day one. We've actually had people sign for their policy and sign for that policy loan.
No.
So
yeah, and they pay off a car, they pay off a student loan, they pay off a credit card.
Yes.
They go buy a rental property.
And it makes sense why people come to see us then when they have money in the bank, because now they can, now I have money to sit down with an advisor. But really in the back of their head, they're thinking, but I kind of want to pay off that debt.
Yep.
And when we talk about them, we're like, hey, let's do both. Like, yeah, how about we do that?
And so it's always part of a plan when we're taking loans, or typically to buy an asset that produces cash flow, or to wipe out a debt. So,
and then we want to then pay that back as fast as possible. We don't want to leave it out, right?
So this is my next favorite one. Why isn't everyone doing this?
Yeah, it's not something you just stand around the water cooler and be like, hey, so I overfunded some life insurance today. But yeah, so this is a system over time that produces residual cash flow. It's not something that everyone does. And honestly, I think people, advisors that help people do this concept, are overselling this thing.
Yeah.
And it's not with a comprehensive plan that actually helps them take money in, put money back. And then I would also say that there's advisors that have used this thing like you wouldn't believe, and they're only getting the premium check 1 year, and they're hoping that the clients understand it from then on out. I'm telling you this. You've understood the banking process, but at first it was clunky.
Mm-hmm.
And so you need advisors to be walking through, even sometimes weekly, to understand this concept, and to have advisors that will walk side by side with you to understand this concept. Eventually people get it and they love it. But at first it's a little, okay, what about this? What about that? Like, you need advisors that are going to stand
I want to address the next one. Dave Ramsey says you shouldn't buy whole life. So the two main arguments that I've heard, and I haven't listened to all Dave's stuff, is basically there's no cash value up front and the death benefit doesn't grow. So you're basically just getting your money back. I would agree with him in that I wouldn't buy those questions, or I wouldn't buy those policies either if it was structured that way. Inherently, the way we design policies, you have 80% plus of your money that you put in cash value up front, day one, and two, the death benefit actually compounds over time as well. So you're going to get, or your family's going to get, or your charity's going to get more money than you ever put in. And so not only is the cash value compounding, but the death benefit is compounding too. So you can have your cake and eat it too. Those are the main two arguments from Dave Ramsey that I've found.
Let's just go back after Dave Ramsey because we love him.
Yeah.
We love him. Buy term, invest the difference. Why don't I do that?
Yeah. And so the argument is the stock market is the better rate of return, right? I think that can be true. Obviously, if you invest in the right things, the actual statistical data from Ibbotson is a group that does statistical analysis on investing in the stock market, says the average investor only makes 2.8% per year. And so you've got to save the difference. And we just don't see a lot of people that actually save that difference at the rate that they probably could. Because again, their money isn't tangible to them because they don't control it. It's in something that's over there. And so, yeah, you can buy term, but as you age, term becomes more and more expensive. And either due to health or your own financial resources, you won't be able to buy it any longer. And it's weird, we've met with, I'd say conservatively, over 500 different people, probably closer to 1,000 over the last 5 years. And I've never met anybody. I think we've maybe met one or two. One or two. Seriously.
Yeah. No,
I count them on our hand.
Yeah.
People that didn't want to leave money behind. And I think as you age, the Bible talks about leaving money to your grandchildren, that type of thing. I think it's just inherent within us that we want to leave a legacy and leave something behind, but we don't want to pay for it maybe necessarily. And the way life insurance has been sold to us in the past, it feels that way. This way, our clients feel like they're able to pass something on and they're not paying for it because they get to use their money too.
For sure. So why doesn't every insurance company sell this, or how do the insurance company make it?
Sure. So like we said, there is a distinct difference. We only use mutual owned companies. And really what that means is just private versus public. So if a company is publicly traded, they're typically not going to have a whole life insurance product. There are a few exceptions, like MetLife has one, and there might be one other. But for the most part, you want mutually owned because they don't have that gumption to go get profits for shareholders. You as the policy holder, it's kind of your way to buy stock in a private company. And these companies that we're using have operated for over 150 years and never not paid a dividend. The dividend's not guaranteed, but again, these companies have never not paid it, even through the Great Depression, even through the 08-09 collapse. So you want to use mutual owned companies. And the reason that, how do they make money is, well, 99% of people aren't doing this. 99% of people are buying term or buying that universal life product that is truthfully probably garbage. And we've seen tons of them. And it's just every time they don't work unless you're funding it and overfunding it and you're managing the investments within it. That's a whole different scale though than what most people are doing. Most people are paying a premium in good faith. They've been sold that this is an investment and they're going to have the death benefit. And I think 9 times out of 10, that's probably not the case. Not to say those companies aren't going to pay the death benefit or anything like that, but if you want to access the cash and you don't have a guaranteed product, it's probably not going to happen.
Because those universal life, variable universal lives aren't guaranteed. They're tied to something else. Like variable universal life is usually tied to the market, and the universal life is usually tied to interest rates. So if those things change, it changes a lot of things in these contracts. And that's why we say use a guaranteed product that you know is going to be there. And if you have a universal life policy, I would challenge you to go and see when that guarantee runs out.
Yeah.
Because it is scary.
Get an in-force illustration if you have any universal life type product, and you'll see that the guarantee probably runs out in your 60s or 70s. So let's keep going.
I would say just one thing, just about how does insurance company make And that is that these insurance companies are amazing at telling us all when we're going to die.
Yeah.
And that's what they're paying you for. That's what they're giving you. Like, you're buying a life insurance product, and they're saying, okay, if you're going to buy this, then we need this amount of money from you guys, from the client, policyholder. And if you do this, we'll guarantee the death benefit. They've also over-engineered these things where they'll also give you some of it back in cash value. You can access that via a loan. We are just using their product that they have written, and we're just accessing the prepayment of the death benefit earlier.
Mm-hmm.
So then we're going to do one of two things for it. We're going to either pay off debt, or we're going to buy an asset that produces cash flow. And that's exactly what your significant other or the person that's going to get the death benefit probably would have done. So
yeah, and I think the last part of the component of like how they make money is they're also sitting on tens of billions of dollars, and they leverage their money out and they loan it to other companies. They invest in stocks and bonds and investments. They invest in private businesses, and they're doing lots of different things to diversify and generate income. And so they make money hand over fist, truthfully. And the business, the companies we're partnering with, they're making more money than they ever have. And the other thing I'd say too that would really help the insurance industry and the banking industry in general is if we could see an interest rate rise from the Fed and help boost the 10-year Treasury specifically. It'll help all treasuries, obviously, but the 2 to 10-year Treasuries are the most important for insurance companies. Just sitting on cash, it actually is costing them so much money because they have to sit on money market type instruments, which are treasuries, and then when they're paying such little yield, it's actually hurting them, not helping them. And so that would also be helpful.
Good point. Okay, so it sounds too good to be true. It probably is. That's what we've heard a lot. And I would say, if it sounds too good to be true, this is, again, not a get-rich-quick scheme, but over time, this can produce a powerful asset for you and your family. And it's actually something you can benefit from right away, because we all probably need a death benefit. We just don't want to keep giving our money away in a term insurance, because at the end of the day, there's only 2% of term insurances that actually get called on, meaning they actually die. And so at the end of your term, whatever that is, you've paid X and you're still alive. And so it just goes away. Their risk as the insurance company goes away, but they still have all your money. So you won, I guess, but you've lost in the cash flow sense. So we kind of align all of those. So it sounds too good to be true. Yeah, it's a system over time, just like banking, and hopefully it'll produce cash flow for you.
What happens if we don't repay our loan?
Yeah, so like Brian said earlier in the show, nothing, right? Like, you don't have to pay it back, but you're just being dishonest to yourself. Now, eventually, you've got to be able to have some money to put back into it. But as long as if you pay the interest that is owed to the insurance company and you pay the premium, they can't surrender that policy, and you can keep not paying.
Yeah. And worst case, you have to surrender the policy, the loan just goes away. You don't have to repay it. I mean, there's no recourse to your credit score or that. And we've unfortunately had some clients that have had to do that, but they got all their money out. They loaned out all the money that they had put in over the life of the contract, and they were really in no worse situation than they would have been. Life kind of kicked them in the butt, and they had free life insurance for 3 to 4 years.
Yeah. What happens to my policy if the market goes down 50%?
Love this one. This is maybe one of my favorite projections. I would be far more concerned about your 401k and your job if the market goes down 50% than your life insurance policy. The 2 main carriers that we use, one raised their dividend in 08 and 09, and one's held the same dividend rate for the last 10 years. So these companies have always paid dividends, even through the Great Depression. I would argue that 08, 09 was a depression. The entire financial system was on the brink of collapse had the Federal Reserve not bailed out Goldman Sachs and some of these other companies. And so we experienced that within the last 10 years, and all of them came through with flying colors. So, and not only that, but our clients were in a position with guaranteed cash value that earned non-taxable interest, and they were in a liquid position to go and buy assets at a 50% discount.
Fire sale. Awesome. Okay, so why would I borrow for my policy, which is 5%, being honest, instead of going to the bank and taking out a loan for 2%.
Yeah. So this is again where people look at this in a silo and they miss, in my opinion, the bigger picture. But when you are consistent in grouping your cash flow together, so like Philip talked about, making your car payment. Let's say you put $500 a month in an emergency savings account. You got car payments of $400 a month, and you got some stupid products you bought that you need to read.
Can we change that, the car payment to 300? Just stick with the same example.
So car payment of 300, savings of 500, and then you got some insurance that's not really designed correctly. You're paying $100 or $200 a month on. So let's just say it's $1,000 a month. By doing all of that money and putting all that money through your life insurance policy, you could be compounding on $1,000 a month. If you put $500 in the bank, it's just $500 in the bank. Your car payment's going away from you. The other, life insurance products probably going away from you at some point. And so you're really only building wealth on $500, and it's not really doing anything for you. Versus compounding in a guaranteed non-taxable environment with a company that's always paid dividends at $1,000 a month. And so when you start streamlining your cash flow and you see the efficiencies we can gain by going through our process, and you start making those payments back to yourself, again, this isn't to Philip and I, this is to yourself in your own policy. The interest rate of making those monthly payments like that isn't 5%. When you pay a loan like that, 5% is the worst case. That's if you never made one loan repayment for the entire calendar year. The year is up. Now you owe 5% interest on a $10,000 loan. That's $500. But if you're paying the interest you're paying the loan payment every month at a much faster clip than you would have because we've helped you synergize your cash flow, the actual interest rate is probably 2.5% to 4%. And it's actually probably commensurate with what you're paying at a bank or a credit.
So let's just talk about that quickly, because you just put $10,000 in a policy, you just took out $7,000, you just paid off your car, and now you have that $300 that you were paying to that car going back in the policy. Then we would probably advise you to take some of that $500, if not all the $500 that you were saving in the bank, combine that with the $300, and now you don't need that life insurance policy. I wasn't really helping you with that $200. So that's $1,000. So at $1,000 a month, you're paying back that policy. How many months would it take to pay off that $7,000? This isn't rocket science. It's 7 months, right? That is quickly faster. It's way faster than you ever would outside the policy. So that's why we said, and on top of that, you get a death benefit. And it's been sitting there like it's been compounding the whole time. So kind of a cool idea. All right, so that's why you would probably want to borrow from the policy. But that's not to say that we haven't leveraged the banks in these comprehensive plans that we've done. We definitely have in the past. So
let's jump to how is interest calculated on the loan. I think this is an important one,
especially right now. Perfect.
Most loans, let's just stick with the car loan. Let's just work backwards. So mortgage 30-year, obviously the balance is amortized over 30 years and you pay for your house twice in interest. We've all heard that, but we don't really change our behavior, unfortunately.
Yep. And it's all front loaded.
Yeah. So you're paying a way bigger chunk of the interest up front. Car loan is somewhat similar, typically on 5-year. Now we have these 7-year car loan notes, which should be interesting to see what happens with that. But cars are lasting longer too. So, but anyways, yeah, the interest is front loaded. And so the main difference is the interest is calculated the same on a life insurance policy and like a bank loan from like a daily rate of interest. The difference is the insurance company doesn't amortize it over a period of years. So it's just kind of like a line of credit or a credit card. The faster you pay off the balance, the faster the interest goes away. And so that's kind of the power of it. And so the faster we can streamline your cash flow is going through our planning process. And we can free up your ability to save money, the faster we can repay debt and get these banks out of your life. And so they calculate interest daily, basically. So if you take out a $10,000 loan on the policy anniversary and you don't make one loan repayment, you owe $500. It's just kind of like simple interest. But in that, if you start making a payment every month, well, then next month, let's say you made that $1,000 payment on your example of $7,000. Well, next month you only, they're charging you interest daily on $6,000, and then $5,000, and then $4,000, $3,000. You get the idea. And so you're paying smaller interest on a smaller balance. that's kind of the inherent difference. And then obviously, we get the policy built up to where you have 100,000 in cash value and you're only taking out a $10,000 loan for a car. Well, now you're earning dividends and interest on 100,000 and only paying interest on 10. And that's where the math can really start to get, a lot more fun.
For sure. Can the government or could the government change the tax treatment on these life insurance policies?
Love this one. Always. They've made several legislative changes to life insurance. The big one instituting the modified endowment contract, which limits how much you can overfund a life insurance policy. But when you look at the tax legislation we just got, no mention of life insurance, upheld the tax protection of life insurance. And for the most part, like we said, 99% of people aren't doing this. And so a lot of people don't have a massive amount of money built up in cash value life insurance. It's in 401k, it's in real estate. So I think they're going to go after those tax places first. But even if they did, the last legislative process grandfathered pre-existing policies and protected those as a class. And then 2, all your money's in that environment now. And so, we're back to where we started. You're going to have all your money liquid to you, and you could move from there to any other instrument or vehicle that you wanted. And you could buy term insurance. I mean, probably wouldn't advise that, but you could take a loan and move your money. So there's always kind of a way out, I guess, in that argument, but all your money's in that argument now. So I'd rather bank on the fact that they don't come after it. And then the last thing I'd say is a lot of banks, corporations, and wealthy people own cash value life insurance. So I don't know that they're going to change the rules on themselves.
Mm-hmm. So let me say this. So let's say there's a listener out there that doesn't have any debt. Can they still do this concept? Should they do this concept?
I would argue yes, because it's a way to get multiple uses on your money. Typically, those types of people like sitting on excess cash, and they're not really earning any interest on it. Typically, they might need a death benefit for estate purposes or legacy purposes. This would provide that. And then 2, would actually give them the ability to leverage against their cash position and add additional sources of residual income.
For sure. Life insurance, we've always heard this, or we've heard this many times, is inflexible and rigid. Would you say this concept is unbanking or the uncommon thinking?
No, I would say if you buy whole life the way everyone else is doing it, then it is rigid and inflexible because you don't have cash in there. But when you infuse the policy with as much cash as we can, without becoming a modified endowment contract, which basically just turns the policy into an annuity from a tax perspective. If we maintain that environment, it's incredibly flexible because we have cash to change, to maneuver. When you don't have cash value and you're locked into a high premium situation, then you're in a problem situation.
Yeah. All right. So last one that we'll talk about today, and if you guys ever have any questions or want to reach out to us, please do so. But we'll go to, why would someone backdate a life insurance policy? And there is such a thing as backdating. When Brian and I first were doing this, and he talked about backdating, I was like, why would you ever do that? Because you're alive and you're just buying life insurance. So it's kind of like saying, hey, I'm still alive, but I want to backdate because 6 months ago, I'll pay for 6 months ago, like I was paying for the insurance, but I'm still alive today. So that was a question I had.
So I want to be careful on this from a compliance standpoint. We do backdate quite a few policies. The insurance companies, I'm just going to say, don't like it because it accelerates the amount of basically what they have to do. It shortens their time scale, and insurance companies just don't like that. But typically, yes, you can backdate. Typically, it's to save age. And so if someone's about to turn 40, and we could secure a rate by going backwards, 3 to 4 months and secure age 39, it locks in their lifetime guaranteed rates for insurance at that 39-year-old rate. So we're going to say it's under the premise of saving age to keep the cost of insurance down. But what it also does from a banking strategy is allows us to interject 2 premium payments into the policy in 6 months or less, depending on how long underwriting takes. And so what that gives us the ability to do is just accelerate the banking system for our client, which is to typically get out of debt or purchase assets that produce cash flow.
For sure. And all this is definitely subject to underwriting and a comprehensive plan for you and your specific situation. But we do have a carrier now that is okay, depending on the situation, with not doing the pee in the cup, blood, urine, all that stuff. So that's kind of a nice, incentive for some people who are like, I don't want needles. We kind of have that idea. So guys, this has been awesome. We've gone a little bit long, but I hope this is something that intrigues you a little bit. It's definitely something that, as you guys can understand, Brian and I geek out about this stuff. And we've seen it so many times, time and time again, how much it's helped clients, how it's put marriages kind of on the same playing field of gaining traction in their plan. So we hope this is something that you guys will start leaning into a little bit more. You won't get super freaked out like Dave Ramsey does about this stuff. There is a way that we can definitely integrate whole life insurance into your plan to help you with the 7 sources of residual income. So I'm your host, Phillip Ramsey.
And I'm Brian Dewhurst.
Guys, cue the music. We'll see you next time. Thanks again. Bye-bye.
That's all for this episode of the Uncommon Life Project, brought to you by Uncommon Wealth Partners. Be sure to visit uncommonwealth.com to learn more about our services. Don't miss an episode as we introduce you to inspiring people who are actively pursuing an uncommon life.